Hey, Daryl, good to see you. Really big financial news. Congress has proposed killing a popular tax move known as the Roth IRA conversion. And this is just for people who are making more than 400K. So I want to understand why this tax bill is important, who could be affected by it, and how it affects my retirement. So if you can start, just break down the difference between a traditional and a Roth IRA.
Okay, so the traditional IRA, when you put money in the traditional IRA, you get a tax deduction, and then that money grows tax deferred until the IRS forces you to take it out, to start taking it out when you're 72, and that's known as a required minimum distribution. The
Hmm.
Roth IRA, once that money's in the Roth account, then that grows tax free for really the rest of your life, and there's no requirement for you to take that money out. So that growth without taxation could be quite impactful.
I can see why. All right. So again, as it stands right now, I can convert my traditional IRA to a Roth as long as I pay the taxes. That's the conversion part. And I think a lot of people are familiar with conversions and they see the headlines the same as I did. And I read through all of them, Daryl, and it was really confusing. And some of the information was rather misleading. Let's break it down. What do people need to take away about how their conversion could be affected?
Well, you're not the only one that's confused.
Yeah.
I read the same things, and so look, Aaron. There's a lot of noise out there. There's a lot of headlines, and what is circulating through the House is not final. We know that then goes to the Senate. There's going to be a lot of changes, and
Right.
there's just a lot of noise. So at the very root of it, a conversion is when you take money that you haven't paid tax on yet and you pay tax at this year's current rates, and then that money goes into the Roth environment. But you have to be very careful. It depends on what your tax rate is. We can get into that a little bit later, but the conversion can be a good thing, but every situation is unique, and we have to be careful because you are paying money out of pocket upfront.
Right. And that is a good litmus test for anybody. So let's delve into that a little bit more because I think a lot of people saw those headlines like I did. And they said, oh my goodness, well, then I should rush out and I should do a conversion right now. But you said no. You said, slow down, Aaron. There are three things that we need to look at first. What are they?
Okay, so the first thing is we want to know the future of your tax rates. Now, everybody always talks about, look, if tax rates are going to be higher in the future, then yeah, I mean, do a conversion. But
Right.
at the end of the day, people often have less money coming in that's taxable when they're retired, and sometimes it makes sense just to pay the tax then. But it's not just the future of tax rates. When I ask people, do you think taxes will be higher in the future? Of course, they'll be higher. Everybody
Yeah.
says they'd be higher, but at the end of the day, it doesn't matter what Frank is paying in income taxes. It matters what your tax rate is going to be. So we really have to be careful that we're not uh, paying money out of pocket right now. It would be better served to do it at a later time.
Right. And then you said the second point is we need to know who's paying that tax.
Right. So is that in the absence of a relative, a very wealthy relative that we've never met? If that's
You
not
wish.
something that's gonna be available for you, then so what I mean by that is that you can either pay the tax out of the conversion or from another source. So let me give you a quick example, Aaron. Let's say it's $25,000 is the conversion amount, and we're going to owe $5,000 of tax on that.
Hmm.
If you pay the $5,000 from your current earnings or a savings account or a CD that's earning 0.5% or something like that,
Yeah.
then the full $25,000 goes into the Roth. So I have this Roth conversion calculator that I can slide back and forth and look at different scenarios. It is amazing how impactful it is to take the money, to get as much money as possible into the Roth environment by paying some of the tax from another source.
Okay. Well, that's good to know. And then the last litmus check here is your investing style, and that's going to be different for everybody.
Right. Okay. So, Aaron, are you a conservative investor or are you an aggressive investor?
I am not good with risk. I'm conservative.
Okay. So, it matters because, so remember, when we're doing this conversion, there's a hurdle that we're doing right now. We're paying some tax out of pocket right now.
Right.
So if you're a conservative investor, it means that the rates of return that we're generating while the money's in the Roth environment, will be less for you than for somebody who is maybe more of an aggressive investor. Because
Yeah.
we have to make more money to overcome what we have done in this calendar year. So again, with that little sliding scale that I can use, if I put in 4% annual rate of return, there's a much less favorable savings from doing the conversion than if I do 7 or 8%. So for conservative investors, it doesn't make enough sense.
Okay. Well, hey, that is good to know. I feel better. You've talked me off the ledge, Daryl. That was good. If somebody also wants to pick your brain and crunch the numbers to see if a conversion is right for them, what's the best way for them to reach you?
So people can reach me at roseadvisorygroup.com. And in the upper right-hand corner, there's a speak to us button. You can click there and get loaded right into my calendar. And as I mentioned before, we can use the sliding scale to figure out if a conversion is the right move for you.
That's great. All right, Daryl, thank you.
Thank you.